let's look at the oil depression, depending on your perspective on this thing. So there are good things about the price of oil dropping. The first is it's a windfall for consumers all over the world. It leads to low inflation. It's a benefit to manufacturers. It's a benefit to the transportation industry. And it's a massive benefit to the U.S. trade deficit, as we'll see in a minute. If we take a look at the bad, though, it can be, and arguably is in some countries, deflationary. It actually makes it harder to switch to alternative energy because at the end of the day, alternative energy has to compete on a price basis, so wind and solar in particular, with fossil fuel energy. North American oil and gas, specifically Canadian oil and gas, is dramatically affected by this. And there are a lot of geopolitical risks, including in countries like Iran, Nigeria, Venezuela, and Russia. And all of these are a significant impact on what will happen around the world. The difficulty here is this, that the relationship between supply and demand has fundamentally changed very dramatically over the last 2 or 3 years, to the point now where the world produces roughly 1.5 million barrels of oil more than it consumes. And it'll take a while before this balance is reached, because I took a look rummaging around the internet for kind of data points, and I found this one outlining what U.S. oil production has changed by each year over the last 50 years. And what you can see here is the oil production increases right up to 1970, and then except for the Alaska oil in the late 70s, every year there's been a decline in U.S. production until the last 3 years. This increase in the U.S. oil production in the last 3 years is 3 million barrels a day. So the theory is that the real problem with the price of oil today is actually the Saudis, that they're producing oil that they're not willing to cut down their supply. The real problem today is not the Saudis, it is actually the Americans who've increased their oil production by such a fast rate that essentially they have created the global surplus that exists. They're 200% of the actual supply. If that increase in U.S. oil doesn't happen, we actually have a deficit of 1.5 million barrels a day, not a surplus. So who's the swing producer? Well, this is he's now deceased. This is old internet stock. But it shows that 5 or 6 years ago, U.S. oil production was less than half of that of Saudi Arabia. And basically today, it's the same. U.S. has slightly higher oil production today than the Saudis do. And who's paying the bills? Well, the other problem for the rest of the oil producers, and this does not apply to the U.S., is how much money they need to get in oil in order for them to run their countries. So what we're looking at here is a whole lot of oil countries. There's the current price of oil, and that's the break-even price. So for Russia, for Saudi Arabia, for Nigeria, Algeria, they need $100 oil, or they cannot run their countries, which means they have to use their oil surpluses from previous years, and eventually at some point in time, these run out. And then the question will be, what are the geopolitical risks going to be? What would happen in Nigeria, for example? What's going to happen in Venezuela? Because none of these countries can support their infrastructure at these prices of oil. The U.S. perspective, gas prices have dropped by 50%. That is the equivalent of a massive tax cut to Americans. I mean, that's also true for Canadians and other countries as well. But there are states in the U.S. that are obviously dramatically hurt. So in Texas, in Oklahoma, in Louisiana, in North Dakota, all of these states, oil-producing states, are going to be hurt dramatically. But in the green, the dark green areas, all of those states are going to have a significant bump in their GDP. In Canada, we have the same issue. 2 provinces, or 3 provinces, I should say, Alberta, Saskatchewan, and Newfoundland, all negatively affected by oil prices. But primarily for the rest of the country, this is a win. So who wins with low oil prices? It might surprise you, but the actual cost of production of oil in North America is not that expensive. The break-even price for most plays currently, including the oil sands, is under $60 a barrel. So there's not huge losses being experienced yet. The problem is, in order to create new oil, that cost is considerably higher, maybe closer to 80. And because of the fact that the current production in oil isn't being severely impacted, this year alone in North America, there will be an increase of 700,000 barrels a day of oil. So this surplus that we have is not going away anytime soon. You know, this could take quite a few years. And from a U.S. perspective, they can look at this from a very interesting perspective as the only country in the world that is producing as much oil as they are and still imports oil. So from their perspective, the price of oil dropping by 50% means their trade deficit went down by $100 billion. So from their perspective as a country, they are far better off with things as they are than they are if the price increases back to $100 a barrel. So we took a look at this. You see all of these headlines, oil's 50, 55, $45 a barrel. It fluctuates up and down. And the headlines are, oil companies are losing money hand over fist, or they're going to be when we take a look at what happens over 2015 and 2016. Now, I can't really see a whole lot out there, but I know that there's some people that are at least 64 out there. And I'm willing to bet that some of you remember an old movie called Giant. It was done in 1956. It had, Rock Hudson in it and James Dean and Elizabeth Taylor. If you haven't seen it, you really should see it. But anyway, it's all about oil prospecting in Texas in the 1920s, 30s, and 40s. And they were making millions of dollars getting oil out of the ground at $1.60 a barrel, which in today's terms is $25 a barrel. So I always just found it interesting to include this because I'm thinking, with their old technology, they could make money at $25 a barrel, and we're scrambling to break even at 50 or 60 today. So my belief is that you're going to see a new wave of technology change how oil is produced and the cost of it. And my guess is this crisis that's occurring will reduce the cost of getting oil out of the ground because there's no shortage of oil. So the price war, the consumers win. And I think our argument tonight is that essentially we see this as not something that the U.S. is necessarily trying to manipulate. By using very creative technology, essentially what they've done is they've created an oil glut. And that isn't likely to change anytime soon.